Hey guys, in this video we're talking about how to pick the best penny stocks. Now this is to get you the maximum possible return that you can. This is of course subjective because it depends on whether you want to 5 times, 10 times or even more your stock picks. Now this is widely regarded to be the most risky, high risk, high reward form of investing, and it is very difficult to get right. Hopefully with these tips today we can reduce the risk that you expose yourself to and maximise your chances of returns. Now this is a high risk, high reward ratio, so if you're getting involved in penny stocks, do please be aware of that. If your risk appetite isn't that high, then do please consider investing in just plain growth stocks that are in more established companies or dividend stocks that are more suited to your appetite. If that sounds like something you're interested in, getting involved in penny stocks, then stick around after the intro and we'll get into it and I'll give you some tips to help you succeed. Catch you in there. Hey guys, welcome back into the video. So now we're looking at what to do to pick the best penny stocks that you can. And the first thing that you should look at is, are they in a hot sector? There is a particular buzz around a lot of sectors out there. Some of these include electronic vehicles, electronic vehicle charging or hydrogen, renewable energy and genomics. These companies command some of the biggest hype values amongst investors. Now if the stock that you're looking into is in that sector, then you've already got a little bit of an advantage already, because straight away there's already going to be interest in this company amongst others, and you can already play that leverage straight away without having to do any more research. And the next thing you want to look into is there any upcoming news or PR? So what is in the news pipeline coming up that will act as a catalyst to the company? You need to dive into the investing presentations, annual reports, find out the company's timeline as to when some PR events may become available. If you can buy in shares before this news breaks, then that is where you're going to generate your significant return on investment. Institutional or well-known investors might be jumping on board as well. If you can get in at the same time as them or before them and you know about it but it hasn't quite broken into public knowledge yet, that again is something that will generate a return, because people will follow the likes of Cathie Wood into companies almost blindly in some instances, and that will drive up the value of the company. Next thing to look into is, who is the company connected to? Are there any well-known companies that this company that you're looking into has got a letter of intent from or any action with before? So there's companies out there that have links with Apple, links with Tesla, links with Amazon, that sort of thing. There might be small minnow companies, but if they have even just a rumour of a link with companies such as Amazon and the like, then that can generate, again, when that news breaks, that boosts the cost of the share. It can be formal, it can be rumoured, there can be letters of intent. All of these things will drive the value of the share price up. Now the next thing to look at is the product or service. So what is the company that you're investing in actually providing? Is the product new? Is it innovative? Is it a realistic product? Can they actually achieve it, bring it to market, and it's got a sustainable future? It's not just a one-off gimmick. Is it an improvement on something that already exists, or is it a brand new product? How easy is this product or service to copy by other companies, be they other startups or be they larger companies? That is something that is important to remember, because if there's a more well-established company already set up than this penny company that you're looking into, then they could easily take over, and they've probably got more capital to leverage against that. And then the last thing to look at is, does the company have a moat? What is the product that they're providing? Is it unique to them? What have they managed to do? Now this is really difficult for penny companies, because there's a lot of bigger companies out there that have huge amounts of resources that can very easily swallow up products and services and patents and the like. So being very unique and having a moat as a penny company is hard, but they are out there. Has the company got any intellectual property or patents outstanding? Is the product or the service actually patent protected? That is a big one. And do they have any competitors in their sector or around their product already, be they large or small entities? And are there any other patents out there? Now recently I've talked a lot about HCMC. Now they have numerous patents outstanding that actual Philip Morris International has potentially infringed upon. Now they may well get rewarded, or are being very well rewarded for that because of the infringement. The court case is pending, so that is something that needs to that will eventually be sorted, but the company will do very well out of a patent infringement. And that is not just the same for this company. Other penny companies could have the same things as well in terms of patent infringements. Next thing to look at when you do your due diligence is to look into, has the company got a strategy in place to grow? Now you can very easily find this on investor presentations, SEC filings, reports, and on the company website. Where is it at? Where is it heading to? This is information that you need to know. Penny companies obviously don't want to be pennies forever. They want the successful ones will have a strategy as to how to grow the business and how to eventually get uplisted on a major exchange, which of course should come with a significant uptick in the share price. Now their goal, and if it's available, should be to reward investors that have been with them for the long term. There should be a roadmap involved in doing that, and then there should be a plan to sustain growth. Now if you're not seeing that in doing your due diligence, then the company that you're looking at may not be the best one for you to look into or to invest in. Cash is king. Cash flow, revenue, and holding cash is important because that is the lifeblood of the business itself. Now this needs to be in obviously cash or assets. A strong business won't liquidate the future viability and future products or liquidate cash to appease creditors. They should have the cash to do that. A high amount of cash or cash flow demonstrates product viability and the company has the cash for future growth and investment to bring and innovate new products. Without cash and without liquidity, it can be very hard for a company to actually achieve anything, and then this might lead on to them selling further shares, which obviously dilutes the share price even further and means that the company will remain a penny stock for even longer, and this isn't a particularly good thing. A low debt or a low loss making is crucial. If a company is loss making and has always been loss making, then the odds are that this company is essentially no good and is always going to make a loss. Now sometimes companies do make a loss, especially in their opening startup time, and they do have a significant amount of debt. And the first thing you need to look at is the debt low, or is the loss low, and is there a plan to get away from this loss, pay down the debt and stop making a loss and turning that into a revenue. If they're being a bit lackadaisical and there is no strategy in place to do this, then again this might not be the company for you. Now there are some key indicators to look at as well. Volume is a big one because it shows just how much a company is being traded and if there is a particular amount of liquidity in that company and how in play it is. Essentially, the higher the volume, the more traders are watching it and the more traders are trading it to make money, which means that you also have the liquidity to trade with. The trouble with some penny stocks is there is literally no liquidity there to trade the shares in the first place, so you could end up literally buying in and then being stuck owning the shares, unable to sell. That is a significant risk, especially with some of the penny companies that are worth less than, we're talking less than a penny. They can also indicate over short periods in a given time period. Volume can also indicate a pump and dump. If there's significant amount of volume going up in such a short period, that indicates a pump is definitely going on, and you should expect that share price to come crashing down in the near future. Now the float is the shares that are actually available for trade. This is calculated by subtracting the closely held shares from insiders, employees and the company's own stock ownership plan from the actual stocks that are on the market available to trade. Ideally, you want the float to be as low as possible, roughly 100 to 50 million shares. When there are fewer shares available to trade, this means that the price can be driven up even easier. If there are hundreds of millions or billions of shares outstanding, it is very hard for such a return to come on your investment, because lots and lots of those shares have got to be sold in large quantities. And the last and final thing that I do want to mention is you need to know your exit strategy. This isn't about picking the stock, this is about getting out afterwards. So have yourself a price target to exit at and stick with it. Be aware of pump and dumps, that is obvious, and if you're going to ride it on the way up, then make sure that you get out before the peak. Essentially, that's where you want to get out. I know that's easier said than done, but you don't want to be holding on too long and then trying to chase the bottom as it's coming out the other side. Don't be greedy, cash yourself out, take your money, move on to something else. It's as simple as that, unless you're super confident in the company that you're investing in. A simple strategy is to make 100% or more on your investment, cash this out with some profit, then you can leave the rest to roll if you're super confident in the company, and then move your initial investment on elsewhere and invest in something else that takes your fancy. That is if you really like the company that you originally invested in. If you don't like it that much and you were literally there to just trade the cash, trade the news, then whip it all out and move on to something else. You also need to be prepared to lose money in the short term and cut losses and exit if needed due to a fundamentals change, a PR disaster, anything along them lines. In penny stocks, it is better just to cut your losses sooner rather than later and get out, because averaging down in penny stocks is very, very risky indeed, and you could be left holding the bag for a very long time. I would suggest only doing this if you are massively confident in the company going forward, and only doing that. So there you have it, guys. Those are some of the rules and techniques that you should apply to pick the best penny stocks out there. Be ruthless in your profit taking, be aggressive, but don't be afraid to take a loss, essentially, to get out and cut before you have to exit and you lose even more money. This is very high risk and only for experienced investors. You need to have the risk appetite for this one and be aware of what you're getting yourself into. Please do your own due diligence when you get involved in these sort of stocks. I don't want to see people losing lots of money. Be aware of what you're getting yourself into. I can't stress that enough. Thank you very much for watching, guys. It's been an absolute pleasure to bring you this video. Hopefully I'll see you in another investing episode. Catch you later.